Today, as you know, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate at 3.5% to 3.75%. The committee is continuing its policy of making ample reserves in the banking system.
That was Federal Reserve Board Chairman Kevin Warsh yesterday after the Federal Open Market Committee met and voted to keep interest rates steady. The decision keeps borrowing costs elevated for mortgages, car loans, and credit cards heading into the fall. It also holds up one of the government's fastest growing expenses, interest on the national debt. Welcome back to the States. I'm Greg Bishop, and we've been previewing some of what was going to be coming up with the FOMC meeting and the things that arrived at the Fed's doorstep this week with Everyday Economics. Co-host of the Center Square's Everyday Economics, PhD economist Orphe Divounguy joins us now. Orphe, what do you take away from yesterday's meeting and the outcome?
Yeah, I mean, look, back in June at the last Fed meeting, we got the release of the Summary of Economic Projections. And what it shows is that most of the people on that committee expect inflation at the end of this year to be around where it is today. Inflation is actually even slightly hotter than where people expected to end the year. You look at the labor market, and the labor market is stable, no longer deteriorating. And the unemployment rate is actually a little bit tighter than what the Fed expected would happen this year. And so slightly hotter inflation than expected, a slightly tighter labor market points to a Fed that could potentially be hiking next rather than cutting. Remember, we came into the year thinking we were going to get more rate cuts. Cuts are off the table. And we had 3 dissents this time with 3 people on the committee pointing to rate hikes as opposed to holding. And so that's where we are today. And what does it mean for households? Well, it means the floor is not falling. It's not getting lower. And that borrowing cost might remain elevated for the foreseeable future.
Yeah, and I was going to have you kind of boil that down. Why should the average consumer care about where the interest rates are, and how is that going to impact them down the line? Obviously, when we talked about this earlier this week, before the meeting, you've got those 4 major pressures that kind of landed at the Fed's doorstep, being the war in Iran. You've got the energy costs, the AI investments, the data centers. I mean, go through those again and how those may have played into this decision yesterday to keep rates flat.
Totally. That's right. The Fed has this mandate, right? So focus on inflation and the labor market. The labor market's no longer deteriorating, and it's, looks pretty good with an unemployment rate at 4.2%. But you look at the inflation side, and there are so many forces at play right now pushing inflation higher. You got tariffs, right? Nearly half of firms that pay the tariff say there are more price increases coming. They are going to pass those costs to consumers. So that's pressure on prices and ultimately inflation. You got war in oil. The conflict overseas in the Middle East threatens shipping routes. Oil and transportation costs have surged. And so everything, when oil prices rise, it touches everything, from food prices to, the cost of the stuff that gets at your front door coming from Amazon every day. There's the AI spending, the AI investment. In the short run, I mean, the hope is that in the long run, AI will make workers more productive. But in the short run, it adds to demand and fuels prices as well. And then, of course, you have deficit finance spending from the government planning to borrow $671 billion this quarter alone. All of that federal spending and borrowing is also adding to demand and pushing pressure on interest rates. And so all of those factors right now point to higher interest rates, not lower. It points to fuel on prices that causes inflation to remain stubbornly elevated in the near term. And so for that reason, the Fed, focused on bringing inflation lower, has to keep interest rates where they're at. And some members of the committee are even now considering a rate hike.
So, Orphe, what's next? When do they review this again and make a decision whether to, cut, keep flat, or increase that interest rate?
Yeah, I think they're going to continue. They basically told us, right? They're going to continue looking at the data, wait for the data to come in, and then decide. Right now, we had a little bit of relief, right? We had, the gas prices had come down a little bit when we had some hope that this conflict overseas was going to end. The conflict hasn't ended, and kind of heated up a little bit. And of course, gas prices went back up. And so there isn't a lot of hope left for a rate cut this year. And I just don't expect it. I think ultimately the Fed should probably hold. Why do I say that? I say that because the increase in prices, coming from the supply side forces like the oil, for example, the increase in oil, the tariffs, those are taxes on the consumer. They act to squeeze the household balance sheet. And those taxes on the consumer ultimately are going to lead to consumers pulling back. And if consumers pull back, interest rate hikes, right? Any kind of increase in interest rates could potentially be disastrous for a consumer that's barely hanging on right now.
Well, Orphe, there's going to be a lot more to be said about this in the months ahead and the impact on those consumers all across the country. And be sure to subscribe to Everyday Economics, where you can get a breakdown of what is happening with the economy impacting your wallet, your household finances. Greatly appreciate you taking the time here with the States.